Welcome back. The Federal Reserve raising interest rates last week for the first time this year. Positive economic growth is now leading some investors to expect 5 interest rate hikes instead of 3 or 4 as interest rates creep up and worries about inflation continue to rattle investors. Joining us right now to talk about fixed income, the Federal Reserve, and markets in general is BlackRock's Global Chief Investment Officer of Fixed Income. Rieder is with us right now. BlackRock manages $1.7 trillion in fixed income assets, and that is your purview. Great to see you, Rick.
Good to be here.
Thank you so much for joining us. So first, let's talk about the Fed. I don't know. I had not heard 5 rate hikes before this week. What do you think? Is that crazy?
Yes is the answer. I mean, the Fed is, and they were pretty clear. Chip Powell was incredibly clear. They're going to move somewhere between 3 and 4 times. They're going to react to the data. Inflation is accelerating. It's important, and it allows them to move what we think will be 3 to 4 times this year, and then, by the way, do it again next year. But do they need to speed the pace up with inflation still? Their core measures running at under 2%. They're in no rush, and so they're going to do it. So I don't think 5 times. But it is important because we're in a different regime now.
I want to talk about how you're allocating capital in fixed income, but also how you see equities. But first, give us the backdrop, because just the fact that there's this assessment that we could see 4 rate hikes tells you that things are getting better, right? The backdrop.
Yeah, totally. U.S. economy, we could create 5% nominal GDP this year. That's a pretty impressive number.
Are you kidding me? 5% nominal?
Nominal GDP. So when you take, so let's say you get 3% real, 2% inflation-ish, and you get about 5%. There are people who think it's going to be higher than that. By the way, the first quarter of the year is always slower. And, as we get into the second, third, fourth quarter of this year, the numbers around what's driving capital expenditures being higher, growth is going to be pretty good. It allows the Fed to move, but the Fed's not going to try and choke the growth off, but it allows them to move. But there's some pretty important things, because as the Fed pulls back, we've been living in this world where the Fed, it's a put to the Federal Reserve, because the view is that as the Fed keeps easing or keeps policy easy, things will be okay because they'll just keep going until the problem is solved. More organic economy, good economy, but you're going to have more volatility attached to it.
Yeah, because we didn't see any volatility last year.
No.
We started the year off with a lot of volatility.
Totally. And the VIX index operating at these very low numbers, it's not normal. But this is because the central banks have flooded the system with liquidity, kept rates low. Now it's going to be a more normal environment. But people have to be used to it. You're going to get a bit more volatility. It doesn't mean that equities can't go up. I think they will. But you're just going to have to absorb a bit more volatility because the Fed is gradually pulling back.
So look back and look ahead for us. The first quarter is now officially over. We saw the stock market not do well in this first quarter. What was most stunning to you in this first quarter, and what does the rest of the year, or the second quarter at least, look like?
The thing that was the most incredible is you had 2 different parts to this quarter in such an extreme way. I mean, think about January was all that people wanted to do was buy call options, get me as much exposure to equities up, and then it was how do I get out in the last couple of months. So I think what people are going to do now is take a step back and think about, okay, where are we going and what sort of drove this? There was certainly news around trade. There was certainly news around technology stocks. The front end of the yield curve we just talked about has moved up. So there's a lot of cross currents. I think when people step back and think about what's going to happen, growth is pretty good. I mean, growth is going to be pretty good. Inflation is moving higher, but not that scary a way. Markets are going to be in pretty good shape. So I think you'll have, still some volatility, but generally what will be pretty good markets.
So you would be putting money to work in stocks, but you also want to own the front end of the yield curve.
Yeah, I mean, so there's ways to make money in investing today, but they have to be different. The regime is different than what it was 2-3 years ago. When you can't keep rates at 0 for a long period of time, people have to search for other ways. How do I get yield? Dividend stocks get me yield. I'll get into the high yield bond market because that gets me yield. Now you've got other alternatives. It's part of why you don't have to own as much in high yield bonds. You don't have to own as much necessarily in equities as you did before. But it doesn't mean they can't go up. But so now what do? You can own the front end of the yield curve, which has been a 0. So you can own 2-year treasuries and carry over 2%. And then maybe I'll take some equity exposure and trying to get some more return on my portfolio. It's much more a normalized state of equilibrium than, oh my God, I'm at 0. I better find other ways to get the risk. So I think people have to think about that differently. Parts of the emerging markets go global to try and get your income. It's a very, very different regime than last year, 2 years ago, and I think people now are just now starting to adjust to that.
So even if you own the 2-year and you're talking about 1.6%, you're still talking about a level that's under inflation.
So, I mean, 2-year treasuries now are almost 230, or actually right at 230.
Okay.
Yeah, so, inflation still, core CPI is running at 180. We think it's going to accelerate a bit higher. But if inflation accelerates a bit higher, what people have to be careful about, if you own long-end interest rate sensitive bonds, what will happen is those bonds can go down in price dramatically, like you saw in the first quarter. I mean, when you break down how fixed income did in the first quarter, it's the long end of the yield curve. It's long bonds that are incredibly sensitive now to small moves in interest rate. So you have to think about where do you have that, and if inflation moves higher, long end, very interest rate sensitive assets can have a hard time.